You get paid on Friday, transfer another piece of your salary into the account, and by Monday you are already risking more because you want the balance to grow faster. The trade itself may look reasonable. The position size is the problem. You are asking one uncertain market decision to accelerate a capital building process that should have taken months. That pressure changes what you see. A normal pullback starts to feel like a threat. A small profit becomes something you are afraid to lose. And when the trade moves against you, closing it means admitting that part of your salary just disappeared. Here is the counterintuitive part. Reaching 10,000 in trading capital may depend less on finding better trades than on refusing to make your account responsible for your financial impatience. Consider a hypothetical example. You deposit regularly, but after 2 losing trades you increase size to recover faster. The larger risk makes the next loss financially and psychologically heavier, which increases the temptation to interfere with the following trade. The problem is no longer one bad setup. It is a chain of decisions created by urgency. So the real question is not simply how quickly you can build the account. It is whether your behavior improves as the account grows, or becomes more dangerous because the money now feels more important. Next, we will examine the decisions that separate capital accumulation from capital destruction, deposits, position sizing, drawdowns, and the point where patience becomes a measurable risk control advantage. You add $500 from your salary, and the account balance rises. On the surface, that feels like progress. But if the trading itself lost $200 during the same period, 2 very different things have happened, and the balance can hide the difference. That distinction matters because the mind tends to judge what it can see. If the account keeps moving upward, you may assume your trading is improving. The danger is not the deposit. The danger is allowing outside income to disguise what the market is actually telling you about your decisions. Imagine a hypothetical month where you deposit $1,000 and lose $300 through trading. Your account is still $700 higher. If you look only at the final balance, the month feels productive. But your salary created the growth. Your trading reduced it. Once those 2 sources are mixed together mentally, confidence can rise without evidence. You may become more comfortable with the same entries, the same mistakes, the same poor judgment, because the account has not delivered the emotional signal normally produced by decline. So keep 2 records in your mind, even if the broker shows only one balance, what you contributed, and what your trading did with what was already there. Because eventually, a larger number on the screen will tempt you to make another assumption, that more capital means you are ready to risk more of it. You are sitting at 9,200, and suddenly an ordinary trade feels more important than it did at 4,000. The setup has not improved. The market has not become more predictable. Only the distance to your target has changed. That distance can quietly alter your judgment. When 10,000 begins to feel close, you may start treating each trade as a chance to finish the job. A setup you would normally reject looks acceptable because it could move the account forward. A modest position starts to feel inefficient because the remaining gap seems small enough to close quickly. The problem is that the market has no knowledge of your milestone. It does not become more cooperative because you are $800 away. But once you attach urgency to that number, you begin asking the market to obey a schedule created entirely in your own mind. Watch what happens before the order is placed. Are you judging the trade by the same standard you used months ago, or are you calculating how much closer a win would put you to the goal? That small shift matters because the moment the target enters the trade decision, selectivity can begin to weaken. The 10,000 figure can still have a purpose, but it must remain an accounting destination, not an instruction to the next trade. And when the balance finally does grow, another question appears: what, exactly, has earned the right to grow with it? Your account is larger now, so increasing position size can feel almost automatic. The balance changed, therefore the risk should change with it. But those 2 facts are not the same thing. A larger account tells you how much capital is available. It does not tell you whether your decisions have become more reliable. Your entries may be no better. Your exits may be no cleaner. Your ability to follow a plan under pressure may be exactly where it was months ago. That is where scaling becomes dangerous. If your decision quality stays constant while your exposure increases, the same mistake simply becomes more expensive. A late entry that once cost $50 may now cost $100. Nothing new was learned, yet the market is charging you more for the same error. So before increasing risk, ask a harder question: what evidence has actually improved? Not the balance, not the passage of time. What has changed in your execution that deserves greater exposure? You might require a meaningful sample of trades taken according to plan, with consistent risk and fewer execution errors, before changing size. The point is not to avoid growth. It is to make growth answer to evidence. Because when larger size is introduced before your behavior is ready, the first serious loss does more than reduce the account. It can change the emotional purpose of the trade that comes next. You take a clean loss, close the position, and tell yourself the trade is finished. But 10 minutes later, you are scanning for another entry with more urgency than before. That urgency is the real continuation of the first trade. A loss can create a private sense that something must be restored. The next setup is no longer judged only by its own quality. It is carrying an extra assignment to recover what was just taken away. Once that happens, your standards begin to move without announcing themselves. A hypothetical example is simple. You lose $100 on a planned trade. The next setup is weaker, but you enter anyway, because a quick win could bring you back near even. If price hesitates, you hold longer than planned because taking another loss would deepen the damage. One loss has now influenced two separate decisions. The market did not create that connection. You did. Before taking the next trade, observe the reason you want it. Would you still enter if the previous trade had never happened? If the answer changes, then the new position is not independent. It is partly an attempt to repair an emotional balance sheet. Sometimes the important decision is not whether the next setup can make money. It is whether you are capable of seeing it without the previous loss standing behind you. And once you can leave one trade where it belongs, a different problem becomes visible. Why do you feel compelled to trade at all when nothing worth taking is there? A quiet market can make you feel as if you are falling behind. You have capital ready, charts open, and no position. After enough waiting, doing nothing begins to look like wasted opportunity. That is when the standard for action can weaken. A setup that would have looked mediocre yesterday starts to appear acceptable simply because nothing better has appeared today. The market has not offered more information. Your need to participate has increased. Consider a hypothetical example. You normally require several conditions before entering, but after 3 inactive days, you accept 2 of them instead of 4. The trade is not necessarily reckless. It is simply less selective. And when you repeat that decision often enough, more of your capital becomes exposed to ordinary market noise rather than conditions you deliberately chose. That matters because every position consumes more than money. It consumes attention, risk capacity, and the ability to act when a stronger opportunity appears. A weak trade can therefore cost you even when it finishes near break-even. Before entering, ask whether you are responding to evidence or to the discomfort of having unused capital. If nothing changed in the market, why did your standards change? The discipline here is not inactivity for its own sake. It is refusing to confuse motion with progress. But selectivity creates another danger. When several trades finally work in your favor, restraint can start to feel unnecessary, and success itself can become the next source of risk. 3 profitable trades in a row can change the way you look at the 4th. Not because the 4th setup is better, but because your recent results have made your judgment feel more trustworthy. That is where success can become misleading. A winning streak gives you evidence that your recent decisions worked. It does not tell you how much came from skill, favorable conditions, or simple variance, but the mind rarely separates those cleanly in real time. When outcomes keep rewarding you, uncertainty begins to feel smaller than it actually is. In a hypothetical sequence, you take 4 trades according to plan and all 4 win. On the 5th, you enter slightly early because you expect the same rid to work again. On the 6th, you give the trade more room because recent experience has taught you that patience has been rewarded. The rules have not been abandoned dramatically. They have been softened one decision at a time. That is why the important observation during a winning period is not how confident you feel. It is whether your behavior is changing because confidence has risen. Ask yourself, would I permit this entry, this stop, or this exception if the previous 3 trades had lost? If the answer is no, recent profits may already be influencing the process. And as the account becomes larger, even unchanged percentage risk begins to carry a different psychological weight. That is where the next test begins. A 2% loss on a small account may feel tolerable. The same 2% on a much larger balance can feel completely different, even though the percentage risk has not changed. The reason is simple eventually. The numbers on the screen stop feeling abstract. When the account becomes meaningful compared with your salary, you may start translating every fluctuation into real life. A loss becomes a week of work. A drawdown becomes several months of saving. Once the translation begins, the trade carries more emotional weight than the plan intended. Consider a hypothetical trade risking $180. Before, you might have accepted that amount as part of the strategy. Now you look at it and think about what else that money could pay for. Price moves slightly against you, and suddenly closing early feels prudent. Another time, you refuse a valid entry because the dollar loss looks too large, even though the risk percentage is unchanged. The account did not become more dangerous. The money became more meaningful to you. Watch for that shift when you start calculating losses in hours worked, bills paid, or purchases postponed. Your financial life has entered the trade. The question is whether those comparisons will be allowed to rewrite decisions after the position is open. Because once losses begin to accumulate instead of appearing one at a time, the problem changes again, and emotion is no longer the only thing that should determine what happens next. A drawdown becomes dangerous when you treat it as nothing more than a test of confidence. The account is already telling you that something has changed, yet you keep operating exactly as before because reducing activity feels like admitting weakness. That is the wrong question. A series of losses can mean several things. Your execution may have deteriorated, market conditions may no longer suit the method, or normal variance may simply be working against you. You may not know which explanation is correct immediately, but the uncertainty itself is information. That is why a drawdown should trigger a predefined change in operating state. Consider a hypothetical rule. After a certain cumulative decline, you reduce exposure and review the last 20 trades before returning to normal risk. The purpose is not to predict whether the next trade will win. It is to stop uncertainty from being expressed through full exposure while you investigate what changed. Without a rule like that, decisions become emotional. One day you keep trading because you want to prove the method still works. The next day you stop completely because another loss feels unbearable. Neither response is based on a stable process. The important decision is made before the drawdown arrives. What measurable condition changes the way you operate? Because once capital is expected to do more than survive, once it is expected to pay for your life, the pressure on every trading decision changes again. The moment you expect a small trading account to cover a monthly bill, the meaning of the next trade changes. A setup that once had permission to be skipped now carries a financial obligation. Rent is due. A payment is approaching. Suddenly, waiting for better conditions feels expensive, because no trade also means no chance of producing the money you think you need. That pressure creates a dangerous reversal. Instead of allowing the market to determine when opportunity exists, your expenses begin determining when you must participate. Consider a hypothetical account of $10,000 with a trader expecting to withdraw $800 every month. If the first 2 weeks produce little opportunity, the remaining days can start to feel like a deadline. A mediocre setup appears, and the question quietly changes from, is this worth risking capital on? To, can I afford to let this one pass? Those are not the same decision. Markets do not produce returns according to your billing cycle. Once withdrawals become required rather than optional, uncertainty collides with necessity. That collision can make ordinary patience feel financially irresponsible, even when patience is exactly what the situation demands. So be precise about the job you are giving the account. Is it still accumulating capital, or have you already assigned it the responsibility of producing income? Because reaching $10,000 does not answer that question. It only creates the temptation to believe the account has graduated into something it may not yet be. You reach $10,000, and the number itself can feel like evidence that something has been proven. But a balance is only an outcome. It does not tell you how stable the process was, how much uncertainty was involved, or whether the same behavior could reasonably survive another 50 trades. Two traders can arrive at the same figure by completely different paths. In a hypothetical case, one reaches it through a steady sequence of controlled decisions. Another arrives after one unusually favorable trade that contributed most of the gain. The destination is identical, but the evidence behind it is not. That difference matters because milestones create permission. Once the target is reached, you may feel entitled to trade differently, pursue larger objectives, or assume the building phase is over. Yet if the path was fragile, changing your behavior at the milestone only magnifies what has not been tested. So when the account reaches the number you wanted, examine the path rather than admiring the balance. How dependent was the result on a small number of outcomes? How consistent was your execution across ordinary weeks? What happened when conditions were less favorable? The milestone should create questions before it creates new privileges. And there is an even more basic question beneath all of them. When you call $10,000 trading capital, how much of that money is actually free to remain at risk? You can place money in a trading account and still not be psychologically willing to lose it. The difference appears when price moves against you. If part of that capital is mentally reserved for a car repair, a family expense, or something you expect to need soon, the stop is no longer just a trading loss. It now competes with an obligation outside the market. That changes behavior. Consider a hypothetical trade with a planned loss of $150. Before entry, the risk appears acceptable. But halfway to the stop, you remember that the same money could cover an upcoming expense. Now you close early, not because the trade thesis changed, but because the money has acquired another purpose. The opposite can happen too. You may refuse to exit because taking the loss would make that outside obligation harder to meet. In both cases, the market decision has been contaminated by a financial responsibility that existed before the position was opened. So ask a precise question before capital enters the account. If this portion were lost within the risk you have deliberately accepted, would any near-term obligation be threatened? If the answer is yes, the money may be available in a banking sense, but it is not independent enough to behave like trading capital. And even when the money truly is free to remain at risk, something curious can happen the moment a fresh salary deposit arrives. A fresh salary deposit can make the account feel ready for action before the market has offered anything worth acting on. The money arrives, buying power increases, and suddenly you notice setups you might have ignored the day before. Nothing in price behavior improved. What changed was your sense that unused capital should be doing something. That is a subtle form of pressure because it does not feel emotional. It feels practical. You funded the account, so putting the money to work seems like the next logical step. But capital availability and trade quality are separate facts. Consider a hypothetical Friday deposit of $600. On Monday, you see a setup that barely meets your standard. Without the deposit, you might pass. With fresh cash sitting idle, entering feels easier because the account appears to have new capacity waiting to be used. The market does not know when you get paid. A deposit is an event in your financial life, not an event in market structure. That separation is worth protecting. Decide when to fund the account independently from when you decide to trade. If new money enters today, it does not need to be exposed today, this week, or on any schedule tied to your paycheck. Because after enough deposits and a few favorable months, another change can occur quietly. You may stop seeing yourself as someone building a process and start seeing yourself as someone who has already proven one. One strong month can change more than your account. It can change the kind of trader you believe you have become. At first, that shift may look harmless. You speak with more certainty. You feel less need to question your interpretation. A mistake that once would have made you curious now feels like something that must be explained away. This is different from simple confidence. Confidence can adjust when evidence changes. Identity resists. Imagine a hypothetical month where your decisions produce unusually good results. The next month, several trades begin failing for reasons you did not expect. If you have already decided that the previous month proved your ability, those failures can feel like attacks on that conclusion. Instead of asking what you misunderstood, you start defending the original idea. That defense has a cost. When protecting your image becomes more important than examining your judgment, useful information becomes uncomfortable. You blame unusual conditions, explain why the trade was basically right, or search for reasons the market should eventually confirm you. Watch the language in your own mind. Are you trying to understand what happened, or trying to preserve what you recently started believing about yourself? A trader who is still learning can change quickly. A trader who feels the need to protect an identity becomes slower to adapt. And once progress becomes part of how you see yourself, another influence enters quietly, how your progress looks beside someone else's. You can be following a reasonable capital plan until someone else's results make your own pace feel unacceptable. Maybe they trade a larger account. Maybe they started with more savings. Maybe they can tolerate losses you cannot. None of that is visible when you see a screenshot, a monthly return, or a number discussed online. Comparison removes context first. Then it changes your benchmark. Imagine a hypothetical trader adding $400 a month from salary and progressing exactly as planned. Then he sees someone claiming to make that amount in a single morning. His own process has not deteriorated, but it suddenly feels slow. That feeling creates pressure to close a gap that never belonged to him. Once the benchmark changes, behavior often follows. A steady contribution begins to feel inadequate. Conservative risk starts to look timid. A method chosen for consistency starts to look defective because someone operating under completely different conditions appears to be moving faster. The useful question is not, why am I behind? It is, behind whom, under what conditions, and according to whose constraints. If you cannot answer that clearly, the comparison has no analytical value. It is simply introducing another trader's circumstances into your decisions. And even after you stop measuring your progress against someone else's account, one expectation from salaried life can remain deeply embedded. The belief that time spent working should produce something on schedule. You can spend 3 hours studying the market and still receive nothing in return for those 3 hours. That feels unnatural if your working life has trained you to expect compensation from time. You show up, complete the hours, and eventually a paycheck arrives. The relationship is imperfect, but the calendar still promises something. The market makes no such agreement. Consider a hypothetical evening trader who spends 2 hours after work watching price. Nothing develops. As the session gets later, leaving without a trade begins to feel like wasting the evening. He has already given the market his attention, so taking a position starts to feel like producing something from the time invested. That is where salaried logic becomes dangerous. Time spent observing does not improve the quality of the next opportunity. 4 hours without a valid condition do not make the 5th hour more deserving of a trade. Notice the expectation underneath your frustration. Are you disappointed because the market failed to present your conditions, or because you spent time and believe that time should produce a result? Those are different complaints. The practical separation is simple but uncomfortable. Measure a session by whether you observed correctly, not by whether your hours produced a position. The market owes no return on attendance. But there is another trap hidden inside effort. The longer you study one particular idea, the harder it can become to abandon it, even when the evidence starts moving the other way. You spend an hour building a case for a trade. You mark the levels, review the context, wait for the trigger. and then price begins to behave in a way that weakens the original idea. This is where preparation can become attachment. The more work you put into a thesis, the harder it can feel to discard it. Walking away starts to resemble wasted effort, so you begin searching for reasons to keep the idea alive. New evidence is no longer judged neutrally. It is compared against how much you have already invested in being right. Imagine a hypothetical setup you have followed for 2 days. The condition you expected never develops, and another signal appears that contradicts your premise. Instead of abandoning the trade, you lower the entry standard because you do not want the research to end with nothing. But the market does not reward preparation by itself. 10 hours of analysis cannot make a weak condition stronger. Effort may improve your understanding, but it does not purchase a favorable outcome. So decide before the trade what observation would make the idea invalid. Then let that condition outrank the time already spent studying it. The discipline is not to care less about your analysis. It is to remain willing to abandon it when the evidence changes. And once you begin judging decisions by evidence rather than attachment, another question becomes unavoidable. What exactly are you recording after the trade to know whether your process was sound? A profitable trade can still teach you the wrong lesson. You break one of your rules, enter without the condition you normally require, and the trade works anyway. If the only thing you record is the profit, the result tells you the decision was good, but the market may have rewarded poor behavior by accident. That is why outcome alone is a weak teacher. Consider a hypothetical trade where you enter early, ignore part of your plan, and make $200. If you write down only the gain, you are likely to repeat the shortcut. The profit becomes reinforcement. But if you record that the entry violated your process, the same trade carries 2 separate facts. The outcome was positive, while the decision quality was poor. The reverse matters too. A well-planned trade can lose without becoming a bad decision. If you treat every loss as proof that the process failed, you may abandon sound behavior simply because uncertainty produced an unfavorable result. So your record has to preserve both sides: what happened and how you behaved before it happened. Ask yourself what you would want to repeat if the P&L were hidden: the entry, the patience, the rule violation, the exit. Because once you learn to separate decision quality from outcome, a strange problem becomes easier to see. Sometimes the trade that affects you most is the one you never took. You watch a move happen without you, and within minutes the profit you never had starts to feel like money you lost. That reaction is easy to miss because the account balance has not changed. But psychologically, a number has already been created. You imagine where you could have entered, where you might have exited, and what the trade would have paid. Now the next decision is no longer neutral. Consider a hypothetical case. You miss a breakout that runs $300 beyond your planned entry. Later, price pulls back and offers a weaker setup. You take it anyway, because part of you feels the market has already denied you something once. The second trade begins to carry the burden of recovering an imaginary gain. That is different from recovering a real loss. Nothing was taken from your account. The damage begins only when you treat unrealized opportunity as if it belonged to you. So watch what happens after a missed move. Do you start entering later than usual? Do you accept weaker conditions because you want another chance? Do you increase urgency because the first opportunity feels unfinished? The market does not owe compensation for a trade you never took, and once you stop trying to recover money that never existed, another temptation becomes easier to recognize. Abandoning a slow method simply because a faster looking one appears to promise a shorter path to the same capital goal. A method can be working exactly as designed and still begin to feel wrong when progress looks too slow. The danger usually appears during quiet stretches. Your strategy produces few valid trades, the account grows gradually, and another approach starts to look more efficient. More signals, faster movement, a shorter path to the number you want. That comparison can make patience look like evidence of failure. Consider a hypothetical trader whose method produces only a handful of qualified setups each month. After several slow weeks, he switches to a faster style. Before enough trades exist to evaluate the first method properly, He is learning new rules, new timing, and new mistakes. A month later, another strategy looks better again. Each switch feels like adaptation, but repeated switching destroys the evidence needed to know whether anything actually works. You keep restarting the experiment before the sample becomes useful. So separate dissatisfaction from evidence. What specific observation proves the method is failing? Has its underlying behavior changed? Or are you simply uncomfortable with how long the results are taking? A strategy should not be protected from criticism, but changing it because another method appears faster is not analysis. It is impatience wearing analytical language. And once you begin looking outside your own process for a better answer, one final risk appears: borrowing someone else's conviction without borrowing the reasoning that created it.